Tensions are flaring in the Middle East, sending gold soaring on safe haven demand. But just as quickly, the bull spelled and prices took a sharp dive. So what triggered the sudden pullback and what kind of key factors could shape gold's next big move? Catch all the details in As Good As Gold. Greetings, fellow traders. I'm Dylan, a research strategist at Pepperstone, presenting the latest weekly update on As Good As Gold. So gold just had a wild week. We're talking about a real roller coaster ride. Prices shot up above $34.50 after tensions flared in the Middle East, but just as quickly, they turned right back around. This week, geopolitics is still on everyone's radar, but the market's attention is somehow shifting back to something more familiar, like the US economy, tariffs, and that. So now if we zoom in on gold against US dollar daily chart, we saw some serious bullish momentum last week. Gold was up 3.6% on the week. It broke above the early June range around $33.80, reclaimed the $3,400 level, and even tested resistance at $34.30. On Monday, it pushed all the way to $34.50. That had traders thinking we might see new highs, but then a sharp reversal wiped out Friday's gains and brought gold back towards $33.80. That's where bulls and bears are now fighting it out. Keep an eye on $34.30 above and the 50-day moving average below. That's the short-term range to watch for now. So, what triggered all this? Well, no surprise, it was the Middle East. Last Friday's price surge came after a wave of military strikes between Israel and Iran, plus news that US-Iran nuclear talks were cancelled. Safe haven buying came in hot and gold surged. But this week, the Fed started to ease a bit. Why? Because the conflict hasn't really affected oil transport, or I would say export infrastructure, and Iran is reportedly signaling to Trump via its Gulf intermediaries that they're open to talks. That took some heat out of the market, leading to profit taking on those kind of safe haven positions. That said, US Treasury yields remain elevated, even though they've dipped slightly from last Friday's levels. Well, to me, that shows the market still isn't 100% sure whether the US will stay on the sidelines, and that kind of uncertainty is helping keep a solid floor under gold. And now shifting to the macro data, there's been some mixed signals, I would say. The University of Michigan's consumer sentiment for June jumped from 52.2 to 60.6, and both short and long-term inflation expectations came down. That shows consumer anxiety around tariffs and also stagflation may be cooling off. So, rate sentiment improved a bit, which made gold look slightly less attractive as a hedge. Well, looking at the broader picture, the US economy seems to be slowly losing steam. Sure, the May retail sales control group beat expectations, but the headline number dropped 0.9% month-on-month. That's the largest decline since March 2023. And jobless claims still climbing. And globally, while data from Europe and China have improved slightly, thanks in part to tariff concessions, it's still far from a full-blown recovery. Fitch even downgraded its 2025 global sovereign debt outlook from neutral to deteriorating, and the World Bank cut its global growth forecast from 2.7% to 2.3%. So even though the data looks better on the surface, the cracks are still there, and that's supportive for gold. On the trade front, the US is making progress in talks with the UK, Japan, and Vietnam as we get closer to that July 9 deadline, but no deals have been finalized yet. So there's still risk that Trump could or maybe stir things up with fresh tariff threats, something that could drive gold higher again. Meanwhile, US fiscal concerns are creeping back in. May's budget deficit shot back up to $316 billion, bringing year-to-date total to $1.36 trillion. And for the full year, interest payments alone are expected to hit $1.2 trillion. That's huge. And looking ahead, Trump's big and beautiful bill could drive that even higher. It starts with tax cuts and ends with spending reductions, but in between, it risks blowing out the debt burden. Add to that the Fed's cautious stance on rate cuts, and you've got a recipe for sustained gold demand, basically. So to sum it up, gold has pulled back after spiking, and we're back in a consolidation range. Why? The markets are repricing geopolitical risks, reassessing the US economic and outlook, and closely watching tariff developments. And in my view, unless there's a major escalation in the Middle East, gold's geopolitical premium is likely short-lived. Once things settle down, I think traders will refocus on the three big themes: tariffs, inflation, and economic slowdown. That means gold will probably stay range-bound at high levels, but a major breakout is less likely, at least for now. And looking ahead to the rest of the week, we'll keep watching the Middle East and Russia-Ukraine for any surprises, especially if third parties get involved. But the real spotlight is on the FOMC meeting and Powell's press conference. The market expects the Fed to hold rates steady and stay in wait-and-see mode, especially with big policy questions on tariffs, immigration, and taxes still unsolved. Traders are currently pricing in 2 25 basis point cuts, one in September and another in December. So the focus will be on the dot plot, the economic projections, and Powell's tone. What could tip the Fed into action and when? Now, if the Fed surprises with a more hawkish outlook, say by raising 2025 core PCE inflation and cutting GDP forecast, that could put short-term pressure on gold. But with global debt piling up, the room for serious tightening is limited. On the flip side, if the Fed sees unemployment rising and Powell sounds more dovish, that could likely limit any downside for gold. So that's pretty much all for this week. If this video is helpful, don't forget to subscribe, like, and spread the love. If you have any ideas on how the upcoming events might impact gold trading, drop a comment below and let's chat about it. Stay tuned with Pepperstone for more insights and updates. And until then, happy trading.